Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include what kind of moves have been going on since the Fed decision earlier this week, and I guess in conjunction with that, my interview with dataqollab's Adam Quinones on how Fed actions and rhetoric have been influencing bond movement and MBS spreads, and in accordance with that, why mortgage rates have gone up recently. Optimal Blue is the only end-to-end capital markets platform built to power performance, precision, and profitability. Their cloud-native API, First Technology, connects the primary and secondary mortgage markets, helping lenders of all sizes operate more efficiently, manage risk more effectively, and maximize results. Optimal Blue. Modern technology, proven results. Here I am in Austin, in the great state of Texas, for the TMBA's Star-Studded Housing Summit, where change will certainly be studied. And yes, change is a constant. The Fed intends to change its policy of balance sheet runoff, ending it, but still letting the portfolio of mortgage-backed securities mature without replenishing them. I'm hearing from brokers and LOs that their borrowers are demanding lower rates than their locks since the Fed moved. But rates haven't really gone down. For originators out there, it's a great opportunity to be a knowledgeable human instead of a robot, and explain why it isn't the case, that the overnight rates are not the same as 30-year rates. Change may happen with the 2026 midterm elections approaching, and the industry can expect significant stakes tied to a potential shift in congressional power. This week, we learned that any funds from MBS maturities or early payoffs from refinancing will be invested in risk-free treasuries, or allowing the Federal Reserve to maintain its assets at current levels while allowing it to reduce its exposure to MBS. It was a quiet day yesterday as we were reminded that when bond prices go down, rates go up. U.S. Treasuries extended their post-FOMC price decline, with longer maturities leading to losses amid optimism following President Trump's meeting with China's Xi Jinping, where both sides agreed to ease certain tariffs and trade tensions. Bonds finally found support later in the day yesterday as equities faltered, while key economic data releases were delayed due to the government shutdown. In news more specific to the mortgage sector, for the second straight week, mortgage rates fell to new year-to-date lows in Freddie Mac's primary mortgage market survey. For the week ending October 30th, the 30-year and 15-year mortgage rates declined 2 basis points and 3 basis points to 6.17% and 5.41%, respectively, and are 55 basis points and 58 basis points lower from a year ago. To make sense of all this, I wanted to welcome back onto the show dataqollab's Adam Quinones to talk about how Fed actions and rhetoric have been influencing bond movement and MBS spreads. He's a data expert and bond market aficionado, if you will, having recently worked to drive growth in AI-based trading, but more recently, he just wants to bring data to traders.
Let's start with where we left off last time, and that was when nothing was making sense. Nothing. U.S. Treasuries were behaving like a developing countries. Does what we've seen here recently, stuff's been kind of range bound. Is stuff making sense to you now more than it was a couple months ago when you were up all night doing math equations for the fun of it?
Everything makes more sense from a curve perspective, a term structure perspective. So I believe the last time we talked about this, I think I raised points about the electronification of markets and how the structure of who was making markets. So firms like Citadel, non-banks, and electronic trading and high frequency trading and short dated options was skewing the perspective of reality. And essentially what has happened over the last few years, like since summer of 2022, is the market has consistently gotten ahead of what the Fed is doing. And we've had these buy the rumor, sell the news events on Fed Day, which we had Wednesday. And honestly, kind of the last few months have just been ho-hum, kind of shrugging it off because we've hit a point in Fed policy where you can be skeptical enough on cuts and not be wrong. So you can say, I think the Fed's not going to cut and the market's ahead of itself, which has been happening a lot. And the rewards are there from that Citadel perspective, that fast money perspective, but the curve has consistently stayed at near 40 to 60 bip spread, and I'm talking twos, tens. And that's how I've operated for a while now, is just where's the 2-year Treasury note? The 2-year Treasury note tells us where Fed funds should be in a year. And what's the spread over twos? And that tells us where 10 should be. And it's been consistent around 50. It's worked for me.
So when you bring up the phrase term structure, because obviously not everybody that listens to this podcast works in capital markets. What does term structure mean, and what's important about it, and what are we seeing with term structure here recently?
The par yield at a par price on different spots of the curve. It's the relationship between time and yield. That's it. So to me, if I'm talking about term structure to this audience, I'm just saying the spread between the 2-year Treasury yield and the 10-year Treasury yield.
Okay.
And I essentially, since July 2022, have used the 2-year Treasury note as my beacon and said, there's going to be a spread that I can use to forecast the 10-year Treasury note. And I'm going to be able to use that spread to tell when the market is ahead of itself. And then I'm going to be able to use that spread to say this is interest rates are properly priced. And this year, specifically, the fact that the 2s-10 spread has stayed around 50 basis points. So if 2s are at 350 and 10s should be somewhere around 4, which has been working very well. And that's because the Fed has told us this time next year, we think that the Fed funds rate will be around 3.5%. So the 2-year Treasury is traded somewhere around 3.5%. And even after Jerome Powell threw cold water on expectations for more cuts in the near future, the 10-year Treasury still isn't so far away from 3.5%. And 10s aren't so far away from 4%. It's not that big of a deal.
Well, I saw in your commentary, you said short-term interest rate traders are skeptical of the future rate cut path. And Chair Powell in his conference, he said a December rate cut is not certain. There's a lot of people out there that are saying, hey, look, inflation is still 50% above the Fed's 2% target. Why are we cutting? Your take on the future path of monetary policy. And you could say, let's do from AQ's perspective, and then let's do from what you think the Fed will actually do's perspective.
It's a good way to put it, man, because I'm jaded about it all. I think I called after the September meeting when the dots came out and I watched Jerome's press conference. I called him Bernie Lomax, like lame duck and just like a dead man walking. He cut, and you could tell that he was just talking through his teeth with frustration. And I raised this to some of my closest inner circle people and saying, did you notice he just seemed to be indignant almost? And over the 3 weeks that followed that meeting, you kind of heard the Fed back away from some of the dovish tones that the market was picking up on and saying, well, let's put an asterisk on all of this and say that the economy is actually doing okay. And yeah, the labor market in July was alarm bells went off, but a lot of things haven't gotten worse since then. And we heard that yesterday in the statement and in his press conference. Sure, the labor market showed signs of weakness, but it hasn't gotten worse since then. And at the same time, we're really not sure about inflation. And it's still above where we expect it to be, and we're not getting the data that we need. So, I think the cut in September was forced but needed. I think that the cut this month felt a little bit more forced, but I think it was still needed. I think that a cut in December I'm not sure it's needed. And I don't think that the Fed is, and you can tell by the tone of Jerome Powell on the podium and also in the votes. One guy voted not to cut at all. And one guy said cut twice. That was Trump's guy. So there's obviously an eyebrow raised there, but I don't know. I don't see when the Treasury Secretary is telling us how great the economy is and how things are balancing out and how there's no reason to be nervous. Main Street's in good shape. Why are we cutting?
I get the sense that Trump appointing Stephen Murin to the Board of Governors has almost made other FOMC voters dig in their heels in ways that maybe they wouldn't, as a natural counterweight to that. We've seen the market ahead of the Fed here for a long time. Market says, hey, 2024, we're going to cut 6 times.
Mm-hmm.
start of the year. What's it going to take for the Fed to get ahead of the market? Will we ever, like, what would it take? Will we ever get there?
That's not the Fed's job. The Fed, they're economists, so they need evidence. They won't necessarily get ahead of the market. We had the COVID thing where they started buying 1.5 TBAs before they were being produced. So that's one of the biggest examples of the Fed doing that. And it would take some event on the level of everyone loses their job, a bunch of people lose their job, like more people than expected at like a 10x type multiple. But that's not how the Fed operates. They're not going to front run what they think is going to happen. They're going to wait for evidence, which is why there's a cautiousness from the Fed right now. Like they don't have all the data they need. They're doing their best. And like I have spent many years collecting alternative data sources to get a more detailed, more granular view on how the labor market's changing, how inflation's changing, like where is it changing? But in the end, the government data that comes out is still the best source of data, and they're not getting it. And there's nothing that they can really do to feel confident about their decisions until they get that data. And that's just one of the bigger asterisks on why they're going to be hesitant to cut in December.
You don't think there was any way they got some of those data points that the public didn't from the government here for the October?
And I have walked the halls of the Eccles building and seen the Fed chair's office. And I mean, I worked at one of the top 2 market data vendors in the world. And so we naturally covered these people, and I have never once gotten the indication that they're receiving anything more than what we see officially.
Wow.
Like they may have a larger inbound messaging number of people that are inbound messaging them on anecdotal evidence, but that's from a government perspective. No, like you're basically asking me, do I think that the BLS has got data ready before and has the data ready? I don't know if you've got friends that work for any of these government agencies, but they're all kind of like, well, not working tomorrow. What are we doing?
Yeah.
Like, these people aren't working.
Yeah, that's a good point. So let's talk about some of the market response to the Fed here. We saw mortgages were repriced for the worst, spreads widened. The widening intensified after Chair Powell's press conference concluded. Why do we see the market movement in that sort of fashion?
So I started off our conversation, or I mentioned it earlier on, that I've been using the 2s-10s spread as my canary in the coal mine to understand directionality, bias, sentiment, all these things. And it's because the world is so sensitive to everything the Fed says. And I feel so strongly that the 2-year Treasury note does reflect where the market thinks the Fed funds rate should be in a year. So from that perspective, if there's an absence of headline news that would give us some reason for a flight to quality or a flight to safety, absent funding, like major funding problems, the 10-year Treasury is just going to be range bound, which is what I said to you guys last night when you asked me, like, what the hell happened? Like, why did mortgage rates rise?
But so you're basically saying with this range bound theory, if you will, that if the target Fed funds rate range is 3.75% to 4% right now, the 2 years around 3.5%, there's only room for 1 to 2 cuts over the next 12 months. That's essentially the way to look at it.
Yeah, I'm looking at the dot plots, and the dot plots are what tell us, okay, that tells 2-year Treasury where to be in a year. And traders, short-term interest rate traders, will naturally calibrate their expectations and their view based off incoming news, which haven't had a lot of lately, besides things on Truth Social and stuff that makes it a lot of noise that is hard to follow. This is going back to the term structure comment, where I'm looking at all of the different pricing metrics for risk at a certain time, 2 years ahead, 3 years ahead, 10 years ahead. And well, all I'm saying is the 2-year Treasury note tells us where the market thinks the Fed will be in a year. The market went down to twos went down to what, 340, which is what is in line with the 1-year forward dot plot. My point is the 10-year Treasury, which is more influence over mortgage rates, there has not been enough news that far out in the time horizon for us to do anything more than just try and peg ourselves to the 2-year Treasury note. So we're essentially saying that our entire mortgage rate's entire future is dependent on, one, headline news, and two, the market's view of Fed policy.
Do you put any credence in the people saying Trump's keeping the government shut down so that interest rates can go lower?
And so when this happened,
he's going to get it one way or another. He's going to
no. On October 1st, when this happened, I actually said this is convenient for the Fed. The Fed truly cannot justify further cuts without weakness in the labor market. This is one way for that to happen, and that was the sarcastic, skeptical side of me, which you're always going to hear. I think that's normal. Like any bond trader, they should have a healthy skepticism around everything. My wife gets frustrated at me she gets frustrated with me about it because I'm skeptical. There's no proof. There's never going to be proof. What day is it? October. We're still shut down right now. We're shut down.
What are you dressing up as?
You want to see?
Well, the people that are listening to this podcast can't see, so maybe I'll explain whatever you show me. You're wearing like a rice patty grower hat with a skull.
So it's just a hat fits my giant head.
Skull
Where's
shiesty.
my hands? Hold on. Where's my hands? Did I leave them inside?
It's a costume. It's
not a costume at all.
Sure. All right.
It's a dad walking around with his kids.
Yeah, it's a dad walking around.
I am 3D printing a skull mask right now.
It's kind of cool. Let me ask one more serious question before I let you out of here, since we're falling off the rails rapidly. Where do rates go from here? Where's the Fed go from here? Where do things?
Yeah. So can we talk about mortgages specifically for a minute? Please. Because the whole range bound conversation, my comment back to you was it's a jaded view on my experience since 2022. Where the market consistently gets ahead of itself because it's been electronified and there's short-dated options that allow people to take risks with get big rewards with little risk. I think mortgage rates have been so interesting in the last 6 months, maybe more, because the idea of being first touch on a borrower. So if you're servicing a portfolio,
I call it recapture wars. Yeah.
The recapture wars are huge. And remember, I spent a couple years running an AI company or being the president of a division of an AI company. And this is what we focused on. It was how to use agents to improve recapture, to improve onboarding. So when a borrower was going through your onboarding process, that they didn't just walk away and go to some other lender who had an easier onboarding process. We've seen since early September some interesting pricing dislocations in rate sheets, and 6 1/8 has been better priced than 6 1/4. And the sensitivity of mortgage rates to what's gone on in the bond market has kind of dulled down a little bit, simply because we're seeing servicers or correspondent buyers and buyers of co-issue at the servicing windows, the cash window, be very aggressive to try and acquire borrowers. I believe that the valuation of mortgages like TBAs, MBS pools has filtered into the TBA screen, and we've seen lower mortgage rates than expected, meaning the primary secondary spread is tightened. The amount of room to widen if rates sell off, there's a lot of room, because it's okay, cool, we just acquired a lot of borrowers. Let's reevaluate and figure out what we have. And then if rates start to rally again, let's be aggressive with our strategy. And that's what happened after August. In September, we just saw crazy excess mults in rate sheets. Over the next, if rates do continue to rise, so let's say that 2s go up to 375 and the spread and 10s go up to, let's say, 4 1/4, there's room for mortgage rates to go up very, very fast.
Much more room to go up than to go down.
Yeah, like we've tightened so like mortgages have outperformed treasuries so much since early August. I mean, the nominal spread
Which
on
essentially means prices have gone up much more than treasuries, aka rates have come down a lot more than treasuries. Is that what you mean by outperformed?
yeah, so I mean like let's just put it from a buying perspective. Like people have been like investors have been buying mortgages more aggressively since early August. So the spread between the current the par mortgage-backed security, 100 price mortgage-backed security yield and the 10-year treasury went from 130 down to 100 basis points right before the Fed. That's a lot of tightening. I mean, that's a lot. And commercial banks have stepped back in and been buying mortgages, and because of the way that the coupon stack is shaped, mortgage rates have outperformed, and people like lenders are trying to buy borrowers so they have the opportunity to recapture them in the event of a repricing event. When rates go up, what will happen typically is like, okay, cool, let's take our foot off the gas pedal. And let's let rates go up so there's more moneyness. So we give borrowers more incentive to refinance when rates top. Let's like make rates top faster.
Yeah, interesting. What are you keeping your eye on going forward? What's something that's like I need to look at that consistently?
I'm trying to help secondary people get access to data and make it easier for them. That's what our business is focused on. I'm keeping my eye on that 2s-10 spread for sure to see if we do flatten. So if the 10 spread, if 10s sell off less than 2s, that's important. I'm honestly keeping my eye on like labor market indicators, like anything I can. I have agents I have agents parsing constantly the news to tell me when there's layoffs. And I think that this is something that has not been widely publicized or
I saw a crazy stat today about recent layoff announcements. UPS 48,000 employees, Amazon up to 30,000 employees, Intel 24,000 employees, Nestle 16,000 employees, Accenture 11,000 employees, Ford 11,000 employees. And then it got 97542, Novo Nordisk, Microsoft, PwC, Salesforce, Paramount, Target, Kroger. There's a lot of softening in the labor market that I don't know if it's getting the proper attention right now.
It's not. It really isn't. And again, my experience working in AI at the level I did, coders are in trouble. Like if you do not have a very high level of pedigree where you can orchestrate code and you can work with really great developers and get a lot done at once, you're going to be replaced. And I think that this is happening at a faster rate. That curve is getting steeper. There's a structural change happening in the labor market, and we're just starting to hear about it.
That flies in the face, though, of everything you said about rates have a lot more room to go up than to go down.
If they like, but I'm also at heart a trader, so like I'm willing to let something run until you give me a reason to buy it. Like that's the way the world works. Like that's why I raised to you earlier the electronification of markets and the rise of short dated options. Like this is just the way that things are now. The liquidity, there's so much liquidity in futures and the purveyors of liquidity like Citadel are encouraging risk taking via short dated options. And the bond market is different than it was 5 years ago. Very, very different. So yes, I will continue to in my own personal portfolio set up trades that are bracketed with technical pivots until I have a reason to believe that there's a fundamental reason to change that technical pivot. And that's just that's why the response I gave you last night was range bound. Like twos bounced off 350. They bounced hard. 10s bounced because 2s bounced. The spread still stayed around 50, but 2s bounced because the market doesn't feel as confident that the Fed's going to cut in December, which you could see in the probabilities. They got cut in half.
I'm gonna do something that I hate here, and you probably hate it too. So the dataqollab conventional 30 primary mortgage rate sits around 6.3% right now.
Mm-hmm.
October 30th, Halloween 2026.
Oh God, you're gonna
What's
ask
the-
me locker float.
No, what's the C30 mortgage rate going to be? Sure, locker float. You answer it however you want. Locker float. What's it going to be?
When?
1 year from now, October 31st, 2020, Halloween 2026, when you're wearing the same stupid costume you're wearing
Yeah.
this year.
No, it'll be different, but it'll still be stupid. Less QT, which means the curve will flatten, which means so if twos go, yeah, so and mortgage spreads will widen. So probably,
Ladies and gentlemen, this is a
6 and
long way.
6
This is a long way of him saying rates are going to be about the same. But go on.
6 and an eighth. Yeah, it is a long way, but I'm trying to be precise here. So 6 and an eighth, like I'm.
So you think
I just did like the steps of the math. I incorporated spreads. 6 and an eighth.
if you were a originator, and obviously you're not, you're a trader, not an originator. If you were an originator, what would you be saying to borrowers right now?
Oh man, I love this question. Ignore the ridiculous amount of spam messages that you're getting from your servicer and from anyone that you've ever interacted with on a web page that still have, like, your cookies are still active on. Just because the Fed cut doesn't mean that rates are lower. Call me if you want expert advice and opinion and views on what is actually happening right now. I can never tell you what's going to happen in the future, but I can always help you manage your personal finances a little bit better. And if my onboarding process sucks, tell me so I can go work somewhere that is more automated and a little better.
There you go.
That's it.
That's good. You're ready for an NMLS number. I like that. Good stuff. Always a pleasure talking to you. Thank you.
The September Personal Consumption Expenditure, or PCE report, that's the Fed's favorite or preferred gauge of inflation, and Q3 Employment Cost Index that were due out today will have to be rescheduled due to the government shutdown. That leaves Chicago PMI for October, which will be released later this morning, as the only data point. Markets will receive remarks from Dallas Fed President Logan, Atlanta Fed President Bostic, and Cleveland Fed President Hammock. We begin Halloween with agency MBS prices unchanged from yesterday's close, the 2-year yielding 3.61 and the 10-year yielding 4.10 after closing yesterday at 4.09%. Let's wrap up with a joke and some housekeeping. The guy who invented throat lozenges died last week. There was no coffin at his funeral. The inventor of the USB stick has died. At his funeral, they gently lowered the coffin, then pulled it back up, turned it the other way, then lowered it again. Thanks again to Optimal Blue for sponsoring this week's podcasts. Optimal Blue is the only end-to-end capital markets platform built to power performance, precision, and profitability, helping lenders of all sizes operate more efficiently, manage risk more effectively, and maximize results. To learn more, visit optimalblue.com.